Is Morningstar misleading? Well, they say basically the ineptness of investors. All right, so we're going to dive into this because it's a pet peeve of mine. All right, we'll dive right into this with my man Jeffrey Pataki. It's Patak. Jeffrey Patak. And he and Christine Benz are on the Morningstar YouTube channel. And I like Morningstar, big fan. All right, bad timing cost investors 1/5 of their funds' returns. What? Because I'm just an inept investor? I'm losing 20% of my total return, Jeff Pataki? No way. How could that be? Let's take a gander, shall we? Our study, we found the average dollar invested in funds earned about 6% a year over the 10 years ending December 31st, 2022. All right, so you have an average dollar. All right, the average dollar invested in funds and exchange traded funds and mutual funds and ETFs. All right. And then we're going to compare that average dollar invested compared to the fund's total return. So your average dollar invested, you inept investor, only took 6% a year in returns, yet the fund that you invest in returned 1.7% above that, factored to 7.7% year over year return. Essentially, there's a gap of 1.7% is what Morningstar is saying. They're saying the average fund returned 7.7. The average dollar invested in the fund only returns 6. So we take 1.7 divided by 6, and that's actually 28% rate of return less, or they say they're doing 1.7 divided by 7%. It doesn't, that's the same. That's going to be 20%. But basically, a quarter of your return is left on the table. Why? Because you're inept and you time the market badly. And we'll show you what I'm talking about. While it would be preferable to see U.S. stock fund investors capture even more of their average fund returns, it appears that mistimed purchases and sales were less costly as a share of returns than other classes. So basically, again, we're talking timing. They talk a lot about timing. Let me show you what I'm talking about. Investors struggle to a greater degree in timing their investments. It's always about time. Let's keep going here because I want to show you down here. While investors have made strides in many ways, our research finds that there's still room for improvement when it comes to timing their investments. All right, so basically what Morningstar is saying is you're buying high and you're selling low, and we don't want to do that. So you need to stop doing that, investor, and just start buying low and selling high. And the point is they're wrong. I'm just going to share with you how they're wrong. I mean, they're saying basically because you're buying after the market has gone up, and you're selling when the market has gone down, and you shouldn't do that. But this is not what they think, and I'm going to show you. So let's dive into my man Michael Kitces here, because this is an article that dates many moons ago, 2012. Kitces.com. Kitces is Kitces, Kitces.com, and Kitces this is one of the best articles ever written, in my opinion, on this stuff. Right. So right here, he says, the so-called behavior gap has been quantified most famously over the years using the Dalbar study. I used to use this too when I was a broker and doing seminars. I'd go to the graveyard. If you line up some skeletons at night at midnight, if they could fog a mirror, dude, I'd be freaking doing a seminar in front of them. I went everywhere to do seminars. If you could fog a mirror, I'd do you a seminar. And I'd always use this Dalbar study to basically insinuate that you need me because you managing your own investments, you're leaving a lot of returns on the table. And I remember I read this study in 2022. Michael Kitces' thing in 2012. I said, just something didn't make sense to me. Even looking at the study of how investors don't receive the whole rate of return of the markets, I said, why? It didn't make sense, but it was good marketing. All right, let's see here. So let me go down here, right here. Numerous articles in the newspaper and on the web typically show retail investors as a whole are dumb and imply that they took money out of the stock market near the bottom and are now putting it back in just as the market makes new highs. In fact, he talks about right here. I've seen this interpretation in many books, including books by Burt McKeel, Random Walk Down Wall Street, Larry Swedroe, I think he's with Rockingham or something like that, I can't remember. But anyway, and then Rick Ferry, who I think runs the Boltez blog. While the intention is good to warn investors against buying high and selling low, the interpretation is wrong because comparing investor returns against index returns is comparing apples to oranges. And we're going to take a look at a couple of examples here. All right. Suppose the stock market doubled in year one and then stayed flat for 9 years. Over the 10-year period, the market return is still 7.2%. All right. So let's say we start with $10,000. In year two, and at the end of year one, it goes to $20,000. And then at the end of year 10, it's still at $20,000. Now, again, we started with 10, we ended with 20. What's our rate of return? 7.2%. We doubled our money. Even though there was no rate of return from years 2 to 10, the only rate of return we had was in year 1. Does that make sense? We start with 10, we end with 20. Our rate of return is 7.2%. That's just a fact, Jack. All right, that's a fact. That's what the index gave us, 7.2% a year. All right. Now, over the 10-year period, the stock market is 7.2%. However, if an investor invested $1,000 every year in an index fund that exactly matched the market, the investor would have $11,000 at the end of 10 years. Only the first $1,000 doubled, all right? So the investor says, I'm going to invest $1,000 every year. So he starts, and his first $1,000 doubles to $2,000. Then every $1,000 thereafter stays at $1,000. It doesn't grow. So he has $11,000 in the portfolio at the end of year 10. All right. His rate of return, I think Kitsa says like 1.7 or something like that, 1.7. All right. So he only has a 1.7% rate of return. The index has a 7.2% rate of return. So it looks like he's an idiot. Looks like he left, almost 6% a year on the table. But did he? Did he leave 6% a year on the table? No, because he only invested $1,000 each year. He didn't invest the full thing up front. You see what I'm saying? As such, he looks like he's a poor investor, yet he only had $1,000 to put in the market. So what is he supposed to do? But yet Dalbar and Morningstar and Vanguard, they have all these studies that say, oh, you idiot, the market returned 7.2, you only got 1.7. Let's keep going. The big difference between the 7.2% return on the market and the investor's 1.7 isn't caused by any performance chasing or bad market timing. The investor is just faithfully investing in an index fund for the long term. When the market did well in year 1, the investor simply didn't have much money to catch a good return. Now we're going to do the exact opposite. Now suppose the stock market stayed flat for 9 years and then doubled in year 10. All right, so again, we have $10,000. After year 9, it's still $10,000, and at the end of year 10, it's now worth $20,000. The market still has a 7.2% annualized rate of return, 7.2. All right, now check this out, though. If an investor invested $1,000 each year in that index fund, exactly matched the market, now the investor has $20,000, resulting in a rate of return of 12.3%. It's higher than the market return because in the year when the market was high, the investor had $10,000 versus only $1,000 in the previous return. So the investor said he's doing $1,000 a year, each and every year. He still ends up with, because 1,000 doesn't grow. And at the end of the year, the last year, it doubled. So that first 1,000, the second 1,000, the third 1,000 ultimately ended up doubling at the end of the year. So he has a 12.3% rate of return versus the index only 7.2%. So it's not timing of the market that matters. It's when the returns are captured is what matters. So the earlier in the time frame, the less the investor who's put money in is going to capture because he has less money in the market. The later the returns happen, the more the investor is going to capture because he has more money in the market. And this is why it's misleading. It has nothing to do with you being a dumb and market chasing. It has to do with the fact of when the market returns happen. And because we know, most likely, that the returns are always on this trajectory going to the northeast, you're almost always going to have investor returns that are less than the fund itself, because for people put money in, you're putting money in 2013, 14, 15, 16, 17, 18, 19, 20, but the market is always on this trajectory. But you didn't have enough money in the market to capture those returns on the front end of the time frame. It's stupid to even insinuate that people are bad investors. Because now you could look at sector returns and say, well, if you look at the sector average, yeah, people are probably there because I got a gut feeling about energy or freaking cobalt or whatever it is. You know what I'm saying? Bitcoin. But when you factor in just a good old-fashioned dollar cost averaging, I put 1,000 in, 1,000 in, 1,000 in, 1,000 in, and for the first 9 years, I had no return. So I had I put $9,000 in. At the end of the year 9 is worth $9,000. My next $1,000 I put in, the entirety of my portfolio doubled, which means I did not just get a 7.2% rate of return as my fund did. I got a, 12.73% rate of return. So I smoked the fund itself because I got my gains in the latter part of the time frame. See, so now of course we're going to have lower investor returns because the last 10 years have been so remarkable. What Portfolio Visualizer show? Let's look at Portfolio Visualizer. We're going to put $1,000 in. We're not going to contribute anything fixed. So I just want to see what it looked like, the rate of return from 2000 to the end of 2000 and 10. So we got $1,000 in there. Our compounded annual growth rate was 0.32%. All right, we started with $1,000. We ended up with $1,036 at the end of 2010, beginning of 2011. All right, compounded annual growth rate again was 0.32. That's the index return. It made 0.32% a year. All right. Now what we're going to do is we're going to contribute $1,000 a year into this fund. All right. We're going to contribute each and every year. Let's not even adjust it for inflation. We'll say boink. I guess it doesn't. No, we'll just not even do that. Let's just hit analyze. Let's see what it looks like here. So now we're going to look at this. Oh, MWRR is 3%. So we had $1,000 in there. Now it's worth $14,195. Our compounded annual growth rate, which isn't, that's kind of silly because that just says your initial balance and final balance. So your compounded annual growth rate doesn't mean anything here because it say, hey, because it doesn't take into fact. We can't use a compounded annual growth rate when we're putting in $10,000 more dollars than $1,000. That's not. We don't want to use that. We do want to use it in the last episode of what we just showed you because that said we start with 1,000, we end up with 1,036. We add nothing to it. Thus, our compounded annual growth rate is our index return. But this is what we're looking for, MWRR. So let's see what MWRR says. WRR. We're going to come down here, and we're going to say, the money-weighted rate of return is an internal rate of return taking into consideration cash flows. This is the discount rate at which the present value cash flows equals the present value of cash outflows. Basically, they're saying, so we're adding $1,000 each and every year, and because we have started with $1,000, our payment is $1,000. All right, over, I guess, 11 years from 2000 to 2010? Yeah, it's 11 years of making payments, and we have $14,000 in there. So we did make some money on our returns. We did. We didn't make much, but our total return, money-weighted rate of return is 3%. Yeah, I've already showed you the compounded annual growth rate of the index itself was, 0.32. So we smoked the index. We smoked the index because we just happened to get the rates of return on the end of the 10-year time frame. If we would have got the significant proportion of the rates of return on the beginning of the 10-year time frame, we would have got smoked by the index, just like Kitsis did in his article. I hope this makes sense. Anyway, there is some legitimacy to market timing. I'm not denying that. In fact, again, they use the sector ETFs and mutual funds that show there's a significant discrepancy between a portfolio, its actual rate of return, and versus the actual dollar invested. And I think there's a lot to be said about market timing in terms of, energy is, I hear it all the time, man. I get this. I look at my video I did, don't make this rookie investing mistake. And this guy says, why would I do bonds in the last 10 years? People chase for, I don't have any dispute that people do that. I've seen it with my own eyes. I think most people don't. I think most people just plug. They just plug. I'm putting money in and putting money in and putting money in. And like Chris Barfield talks all about this. Well, let me actually show you something here. This is, if we look at Chris Barfield, he's got a great newsletter that you should follow. It's free. I guess he doesn't have it on his website. I thought he had a sample. He talks about the, let me see real quick. There was a sample newsletter in here. Let me go home because it's just such a great thing where he talks about the, where's that sample newsletter he's got here? Hold on a second. Find it. But he basically talks about how he talks to all these millionaire TSP. TSP is the federal government, the thrift savings plan through the federal government, be it military, be it federal employee. And he says, what do they do? What's the secret to being a millionaire in the TSP? At least the previous. We don't know if it will be in the future. They just plugged away. And the C fund, that's the index fund. They just kept plugging and plugging and plugging and plugging. They deferred for freaking 20, 25 years, and they got $1 million. Nothing more, nothing less. It's crazy. Now, what is their investor return relative to the investment that they invest in the C fund? So their investor return is going to be less than the actual C fund return. Why? Because from 88 when the C fund started, something like that, till 2023, the C funds just took names, man. Stomped butt and took names. You did too, but it won't look as good because they're starting from the beginning of 1998 when the C fund was incepted. And you didn't start at the beginning. You only had $100 in there at that point if you had anything. And that's the difference, man. It's very, very frustrating. People got to know this. And I just give investors a break. Most investors are pretty good, man. They just put money in, they put money in, they put money in, they stay the course. Don't try to time the market. Look, do I do it sometimes? Absolutely. It's stupid not to think. Like right now, I'm getting 5.2 in a money market. Why would you not take advantage of that? Especially if your job, I'm self-employed, is ebbs and flows, man. I know for a fact if I did not ever get hired again or YouTube kicked me off, I would need some money. It's going to have to come from my money market account because I don't have it stashed in the. I don't want it stashed in the. Well, my version, the seed fund, is going to be the S&P 500. Why? Because what happened in 2008? What if my job goes kaput? YouTube says you're no longer here, and all of a sudden the markets are down not 37%, but 57% from October 1st to March 9th of 2000, October 1st, 2007 to March 9th of 2009. Dude, I'm in a world of hurt, so I need some liquidity, and liquidity for me is that money market is paying 5.22, whatever it is. But you're timing the market. You're damn right I'm timing the market. I'm timing the market based on the day-to-day. The stocks in the long run are great, but the long run never comes. I'm here to tell you now, each and every mother's son, you better learn it fast, you better learn it young, because the long term never comes. All right, love to hear your thoughts. Comment the doobie-doo. Give me a thumbs up. It does help with algorithms. So I don't know if it does anymore, but comments always do. We'll see you.